All right, I think it's good for us to go ahead and get started. Thank you everybody for joining. My name is Leslie. I'm with Low Income Investment Fund. We are having today's webinar on tax considerations. I'm going to go ahead and hand it off to Cindy.
Hello, everyone. Good afternoon. I am Cindy Esquivel. I am one of the program managers for the California Infrastructure Grant Program. We work in collaboration with the Department of Social Services. Just a little information on who Low Income Investment Fund is. We have been in business since 1984. We're really committed to supporting and uplifting communities throughout the United States. And specifically with our infrastructure grant program, we're really here to create quality environments for those programs out throughout the state of California. So with that said, I am going to pass it on to our presenter today, Jennifer from Civitas. We are super grateful to have an expert on board to share some important information for us. So you're next, Jennifer.
Great. Thank you. Thank you so much, Cindy. I really appreciate it. I just want to say to the audience that LIIF is taking the perfect time to have this webinar, right? Where most of us haven't filed yet, most businesses haven't filed, and here's the chance to really be well informed for this tax season. So absolutely excellent time for LIIF to be offering this to all of their providers. So my name is Jen Bale. I'm the Director of Professional Learning at Civitas Strategies. I'm joined by my coworker, Tim. We're here today to talk about taxes. So Civitas Strategies has been working with childcare providers across the United States since 2020. On taxes, I should say. So thousands of childcare businesses surrounding taxes, tax education. We do presentations and written guides and information, videos, and some organizations also engage us in tax assessment, and you're going to hear me refer back to tax assessment. So the primary goal of today, the purpose is really to empower you to have conversations with tax professionals, right? I'm not a tax preparer, but I do work with tax education with childcare providers quite a bit, right? So I've been working with everybody for a few years there. Basically, what we want to make sure that the result of us all being here today is that you basically are gaining knowledge through these types of trainings. More providers are gaining knowledge than ever before. We know that you're experts, financial experts in your business, right? You know your finances inside and out, but sometimes business owners don't have the time to be experts in their taxes, and that's part of what we are talking about today. I did mention the word assessment, right? So there are projects that Civitas works with where we actually do an assessment, and what that looks like is I review a childcare provider, business owner, their previous year tax returns. And what I'm doing is I'm looking for any opportunities for missed expenses, any opportunities where maybe there's some calculations that are wrong, or are there things that could raise a red flag? And we're going to talk about some of those red flags, but that's honestly, what happens in assessment. We're going to hit on some of the things that I go over when I'm looking at an individual childcare business owner's taxes. I will say a lot of the center taxes that I review are pretty accurate when compared to family child care. But there are these few areas that I find often, right? I find over and over again. So basically what we're going to do is we've got a long presentation today. There are things I'm going to run through rather fast, and that's because I know as centers, you most likely have this knowledge. Some of it is a little basic, and I want to concentrate on the things that are really the most important to you. The wonderful thing is that LIIF will have this video posted. They will be reaching out via email. They're going to give you a PDF of the presentation. We're going to handle our questions today by putting your questions in the Q&A, or you can hold them to the end of the presentation. I'm going to attempt to have 10 minutes to answer questions. So we're not going to stop in the middle of the presentation for questions, but we will be answering things at the end. And we're also going to be providing, in the chat, you're going to see the web address, tomcopelandblog.com. That's how we're going to handle questions that you think about after the presentation, or questions that we just don't get to in case we have a lot of questions, you'd go to tomcopelandblog.com. A lot of resources there, but also the option to click on what's called Ask the Experts. You can put your tax question in Ask the Experts. You can mention that you attended the LIIF presentation, and then after perhaps a week or so, I'll record a video and post it on Civitas's YouTube channel and provide LIIF the link, and they'll go ahead and I'll answer all those questions, and you'll be able to join there. So thank you. That's a lot to say, but really quick, just going to do our disclaimer that the information that's contained here has been prepared by Civitas Strategies and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information is not intended to create, and receipt does not constitute an attorney-client or any other advisory relationship. Reproduction of this information and the recording of this content, including the use of AI, are expressly prohibited, and only non-commercial uses of this work are permitted. All right, so what I'd like to do now is just kind of break the presentation down into chapters, right? So we can just kind of get these easy to digest. One of the things we're going to talk about today is we're going to discuss business structure and the impact that business structure has on your taxes. This isn't a presentation on business structure, but I start with it because it comes up quite a bit when I'm speaking to childcare centers about their taxes, right? You want to know, do you have the right structure to maximize your tax savings? So a lot of times that comes up. In that portion of our presentation today, I'm also going to show you the 1120S form. Many of you may be very familiar with it. And then we're going to really spend some time on, if you are an S corporation or filing as an S corporation, we're going to talk about reasonable salary, also called reasonable compensation, which is something that the IRS looks at really high focus. They're looking for reasonable compensation / reasonable salary to be reflected on an 1120S tax form. So we are going to spend a little time there. The next chapter that we're going to look at, not groundbreaking, right? What steps can you take to prepare for filing? A lot of you are familiar with this, but it's a nice reminder, right? Because this is the time of the year that we're going to be thinking about that there. I'm going to go into some of those challenging expenses because, like I said, I do a lot of centers that look beautiful, but sometimes the same things are concerned. So we're going to look at some of those. We're also going to touch on depreciation. And I will say with depreciation, you need to have, as a business owner, a really good understanding of depreciation, but most of the time you're going to defer to your tax professional about depreciation. But I want you to know what it's about so that you can have those kind of conversations there. We're going to talk about tax credits. People, I think, sometimes think that tax credits are the equivalent of an expense that you would take off your taxes, and that's not the case there. And we're going to talk about what 2025 can look like, the 2025 tax year. So you can see there we've got a lot of things there. So here we go. You know, why care about your taxes? You're business professionals. You know the importance that taxes play in your business finances. I just like to remind everybody that, you know, it's the responsibility of every business owner to pay their fair share of taxes, without a doubt. But proper tax preparation, right? Basically what that can do for you is be a vehicle to recapture some of your hard-earned profit, right? So we're always going to pay our reasonable share of taxes, but we are going to look for allowable expenses. We are going to look for ways to mitigate our taxes. We talk about risk mitigation in the fact that it is very, very important that you have the education, some of which we're going to talk about today, to understand allowable expenses, and then also to be aware of the things that could potentially trigger an audit. So, you know, it's important that you understand your taxes so that you know how to avoid any types of problems. We know that taxes are a great window into understanding your business's health, right? It's part of you being financial professionals and knowing your business as well as you do, right? So understanding your business's health So very important. We need an accurate account of our profit. Boy, taxes bring that to light. So of course we want to use our taxes to help us with understanding the health of our business, but I also want you to build confidence, right? Because knowledge is key. And a lot of business owners have amazingly successful businesses and still don't feel comfortable talking to a tax professional about the business taxes. Perhaps defer to what they say, maybe have some questions, and maybe that person isn't very receptive to those questions. So really what we want to do is help you to understand your taxes so that you operate in the mindset that you know the rules of the IRS, you're not going to have problems in the future, and you're going to be able to have these conversations that show tax preparers that you are the true professionals in your business. Everybody needs to know about their taxes. So there we go. What I'd like to talk about now is business structure, right? So how does business structure affect your taxes? Well, most centers especially, right, have had professional guidance on the best business structure for them, but sometimes circumstances change. Sometimes you may have some questions. A lot of times businesses think there's got to be something better. There's got to be a better way for me to save on taxes. And that's why I wanted to bring up business structure today, because the right business structure allows you to optimize your taxes, right? To really have taxes that serve the needs of the business versus, not addressing what you really need. We want to mitigate and lower taxes is what we want to do there. Everybody knows, right? We've got nonprofit corporations, C corporations, S corporations, and then limited liability companies, which are can be single member limited liability companies. So we're going to take a quick look. I know everybody knows what these are, but there are a few little things that I'd like to bring up, right? So we're talking about taxes today. Why am I bringing up nonprofits? So sometimes I work with centers who are really thinking about starting their own nonprofit. And that's why I like to just have a mention here, because typically nonprofits are tax exempt, right? But there are really strict requirements around the type of income that a nonprofit can generate. So if there's any income that's ever generated from activities that are not substantially related to the reason the nonprofit exists, those could be taxed. So those are considered to be what they call UBI, which are unrelated business income. So I want people to know that, hey, sometimes nonprofits, they really do get looked at under a magnifying glass from the IRS. So it's a smart idea for you to have professional guidance when it comes to a starting or operating a nonprofit. Some of you may have both, right? You may have a for-profit business and then also have a nonprofit. Nonprofits, right? They're charities, public serving companies. They're run by a board of directors who typically are not employees, especially the employees that lead that organization. And when a lot of people start nonprofits, they think they're also going to be on the board. And I can tell you the IRS frowns upon that. And sometimes that's hard because they're not used to giving up control, right? This is your baby. You started this nonprofit. Now you've got to listen to, and everything has to come through the board, right? So that can definitely be a consideration for people. I also do like to bring up that, remember, when you start a nonprofit, you no longer have a business to sell. So a nonprofit is not something that you own. And I want people to think about going into the future that when you leave a nonprofit, you're ready to retire, fantastic, you've accomplished what you want, the nonprofit's going to go on into the far into the future. You don't have anything that you are selling when you leave. The board may perhaps be giving you a substantial bonus or severance, whatever that may be, but you don't own anything. So I do like to bring that up with folks, okay, just so that you understand when you might form a nonprofit, but it's not something that you actually end up owning there, right? So there are a lot of rules with nonprofits about how the money can be spent. Again, this is why we want professional advice if we're thinking about forming a nonprofit there. They're positive, right, is that there are a lot of grants, a lot of money, foundations, give grants. Government, under certain circumstances, have grants available for nonprofits there. And of course, there is this idea that, hey, there isn't going to be a tax burden. But just keep in mind, as I mentioned, right, the IRS does look to see, is there any type of income there that is not related, is not allowable under the nonprofit as tax-free, and that can be taxed. Nonprofits also, they are supposed to you're not supposed to generate so much profit, right? Nonprofit, you can keep some money in savings because you need operational expenses and an emergency fund and things like that. But the money that's coming in is also supposed to be going out. The IRS looks at that. So there are positives to having nonprofits. There are negatives to having nonprofits. I just like everybody to be aware, because I do often have conversations with business owners. Really, they have wonderful ideas about starting a nonprofit, but maybe don't know how to go about it and don't know about some of the, I don't want to say downfalls, but some of the implications, right? Some of the intricacies. So the next corporation that we're gonna talk about is a C corporation, and I can tell you, I very rarely see C corporations in childcare businesses. And the reason is that it can be very, very complex. So most large corporations that we see out in the world, that we work with in our personal lives, there probably are C corporations. They're all owned by shareholders. They're, like I said, right, they're complex. There's a lot of legal requirements. They actually, you'd think, oh, these C corporations, they must have tons of tax advantages. Well, they actually suffer from what's called double taxation. So the profit from the company is taxed at a corporate rate, and then the owners have to pay income taxes on it. The owners are basically considered to be shareholders. So there's not all negatives about C corporations, but usually, unless we're talking about a childcare centers with many, many locations, becoming an S corporation, which is what we're looking at next, often fills the needs of childcare businesses. If you'd like to become a C corporation, please just do your homework about it, because there's a lot that goes into that. All right, S corporations. So in reaction to C corporations being so complex, the government created a smaller business version of a corporation, which is the S corporation. Stands for small business corporation. So S is standing for small there. It is a separate legal entity from you personally, right? So just like an LLC, your personal assets are protected. You can have up to 100 different shareholders / owners. So that's a pretty high number that you can have there. There's a really, really very attractive benefit to S corporations or LLCs filing as S corporations. So you don't have to be an S corporation to take advantage of the tax benefits of an S corporation. The IRS tax law allows LLCs, who otherwise would be filing as single member LLCs, to declare that they want to file as an S corporation. What does that mean? We're going to look at an example, I think 2 slides from now, but basically, what does it mean? It means that there's a way to reduce some of the taxes by, and we're going to also go into this, by basically paying oneself a reasonable compensation, a reasonable salary, and then the profit after that reasonable salary actually is not subject to self-employment tax. And that's not the case with a sole proprietor or a single member LLC. So, S corporations, they're not difficult to manage. There is work to be done in terms of paperwork and things that you have to have. Even if it's one owner, they want you to hold an annual meeting, which we think is kind of funny there. The record keeping can be stricter, so there's no doubt about that there. But the majority of childcare businesses centers that I work with are either S corporations or LLCs declaring to file as S corporations, because that taxation can look so attractive. Now, this LLC, right, that's the most typical company if we think about businesses overall. the limited liability company. Usually small business owners, there's a lot of flexibility if you have an LLC there. They're governed by the state, so you handle LLCs through the state. And again, if you're an S corporation, this is something that you already know. Many of you are very, very familiar with this, right? But the beauty, again, if you're an LLC, you have the right to file as an S corporation and take advantage of everything that the S corporations take advantage of. So that's fantastic. Keep in mind that LLCs are transferable to partners, to heirs, where there are some difficulties if someone was a sole proprietorship and not an LLC. But an LLC in itself does not have tax benefits. Their taxation is exactly the same as a sole proprietorship. So I will speak to business owners who will think that by becoming an LLC, there are automatically tax advantages. That's not the case. It's when you start to file and declare to file as an S corporation that we start to see tax savings. So I know a lot of you here are very familiar with this. I just do like to bring it to everybody's attention because perhaps there are some of you that are still filing as single member LLCs. Again, you're going to have access to this presentation afterwards, and you're going to be able to see what reasonable compensation is about, because that's something that when you're determining, are you going to file as an S corporation, you need to be able to generate enough reasonable compensation. So we'll talk about that there. So again, right, an LLC that files as an S corporation or an S corporation, there's opportunities to save money. And again, it's because a LLC or LLC declaring to file as an S corporation is a mouthful. And S corporations there pay payroll taxes of 15.3% on those reasonable salary, reasonable compensation, but then the remainder of that profit transfers directly to the 1040s of the owners without additional taxation. If you think about a sole proprietor, what happens to a sole proprietor is the profit that's shown to them at the end of the day on their Schedule C tax form, line 31, that's what the government considers to be, the IRS considers to be their basically their salary. Whatever's on line 31 is their salary. So what happens with a sole proprietor or a single member LLC is that they first and foremost pay self-employment taxes on that line 31 of the Schedule C, and then that still big number, line 31 of the Schedule C, transfers over to their 1040. So they're basically they're paying double tax, right? I just like to give the example in case anyone here is still as an LLC, single member LLC, right, or a sole proprietorship. So here we go. We have an example here where there's $60,000 in net revenue, right? Now, what would happen to a sole proprietor or a single member LLC is in total on that $60,000, they would pay $22,380 in taxes. That's the 15.3% tax for self-employment tax off of the $60,000. And then we're using 22% as an average for income tax. And so they pay that, right? They pay the self-employment tax, they pay the income tax on all $60,000. But if you're an LLC declaring to file as an S corporation or an S corporation, basically you will come up with what's called a reasonable salary, a reasonable compensation, and that is taxed. Your business pays taxes on it, payroll taxes, because that compensation is being paid via W-2 wages. But what's left after that, the profit after that, transfers over to the 1040 without additional taxes. And in this instance, look at this difference. Right? If somebody was filing as an S corporation, they'd only be paying $11,190 in taxes. So that's a beautiful example, right, of why filing as an S corporation, becoming an S corporation, can make a lot of sense. Not for every business, but I like, in case we have anybody who is not familiar with that structure, has always had questions or thinks, hey, just because I'm an LLC, there's tax benefits. I wanted to educate you on that first. So because I work with so many S corporations that are centers or centers declaring to file as S corporations. Want to just discuss the 1120S, right? That is the tax form. Many of you are most likely familiar with it if you tend to go over your taxes after they're prepared. If you prepare your own taxes, you can sleep during this portion, right? You already know this. But basically, the 1120S is how S corporations and LLCs declaring to file as S corporations, it's how they report their taxes. Very straightforward in that it all income, deductions, taxes, payments, and that reasonable compensation, the owner's wages that are paid via W-2. But everything that's left, that profit, just goes right over to the owners / shareholders. Same thing, goes right on over to their 1040. So this is a picture of the 1120S. Again, if you are familiar with your taxes, if you spend a lot of time, this looks absolutely familiar to you, right? Very straightforward. The top is all of your income. The middle are all of your expenses. And what's interesting with S corporations and LLCs declaring to file as S corporations is you actually, they're a majority, I should say majority, a lot of your expenses are actually just going to be shown as one line on the 1120S, and then you'd be attaching a schedule of all of those expenses. And there are a lot in childcare businesses. So that section there, we're going to talk about all of our expenses, and then we're going to calculate our taxes, right? So basically tax and payments, that's that last section. Now there are schedules attached to the 1120S. I'm not going to go into all of the schedules because they do vary. And just so you know, it's not just the 1120S, but I wanted you to be familiar with that because here we are, Jen's favorite topic, right? Correctly determining that reasonable salary for S corporations or LLCs declaring to file as S corporations. Why is it such a big deal? Well, the idea being is that the IRS says, hey, because you're not going to be paying that 15.3% tax on the profit after a salary, we need to make sure that you are paying yourself enough of a salary, that you are not paying a little salary and then transferring everything over to your 1040 without additional taxes. The IRS requires S corporations and those filing as S corporations to basically ownership be paying themselves reasonable salary, reasonable compensation. And that's the reason why. So it's actually one of the number one things that I see when I review a center's tax returns, when I do an assessment, is often a very small number for compensation and W-2 compensation, and then everything else passing over to the 1040. That's what the IRS is looking for. They are looking for this correct balance for reasonable salary, reasonable compensation. What I want people to think about is what should that number look like? It's a pretty wide range there. If you were to take those W-2 wages and the remaining profit is at 30% to 50% of that picture, is that the reasonable salary? That's basically typically what the IRS is looking for. There are multiple methods to figuring out that 30 to 50% to make sure that it's accurate for the things that you do in your business and so on. We'll take a look at a couple of those there. I just want to keep in mind that when you're doing research to determine what your reasonable salary should be, you don't have to look at other business owners. You could look at teachers, right? So if we talk about how we go about determining what's the right amount of reasonable compensation, reasonable salary to pay ourselves, you're going to look at these different, basically these different sections, right? In the fact that we're looking for positions, we're looking that have the same skills and experience that we do, the duties and responsibilities, the time and effort is the same, the size and complexity of the business is the same, and compensation paid to other employees in the child care community for similar positions, right? So that's what the IRS is thinking about when they think about reasonable compensation. You can do it a couple different ways. So one of the things you can see here, right, the IRS audit history is that they are looking for that 30 to 50%. So it is reasonable, but it needs to be defended with the IRS if they were ever to come back. So it's not that that 30 to 50 is unreasonable, it's that we have to show them, if you were ever to be audited, how did we come up with that reasonable compensation? And that's what I want all of you to be aware of, all of you to be able to do, right? So different ways of doing that. So if we took a look here, right, this is what's called the similar job method. All right, very, very straightforward. You look for job openings in your area, you find positions that are similar to yours, you find out what those average wages are, either for that title or for a position that has the same responsibilities as you. And basically, that's how you determine what your reasonable compensation is going to be. If you haven't already done a reasonable compensation, or if after we do today's presentation, you think, hey, this reasonable compensation I've been claiming is kind of low, I don't want to trigger an audit, you're going to want to keep as much documentation as you possibly can. So you're going to want to show them your research if they were ever to come back. All right. We could go through our local community. We could use LinkedIn or Indeed and look at advertisements that for businesses, childcare businesses, hiring in the same position with the same type of responsibilities that we have. But remember, it doesn't have to be a business owner, could be a teacher there. You also can look at the Bureau of Labor Statistics to see what positions pay. But most of the time folks do research on themselves, right? So they want to basically be able to, you want to be able to justify how you came up with that. So we can look for similar job titles. We also can look for similar activities, right? So what does this mean? You actually could calculate your reasonable compensation based on the percentage of time that you spend in different tasks. So let's take a look at an example there. So here we have a situation where, hey, Jackie is the owner, but she also serves, right, as the center director, management position. Normally, a center director in her area would be paid $50,000 a year, but it turns out that Jackie's only doing that 10% of the time, and so on. Bookkeepers make $35,000 annually. Jackie's doing that 10% of her time. Lead teachers make $27,000. She's doing that 60% of her time. Receptionists, administrators make $25,000 a year. She's doing that 20% of the time. By showing those, justifying them, doing the research, documenting, she would be able to say, hey, based on these similar activities, my reasonable compensation should be around $30,000. Of course, I'm rounding there. So that basically is what it looks like. Reasonable compensation, if you are an S corporation or filing as an S corporation, is not something to play around with. But it is one of the number one things that when I see things on center returns that are perhaps not as they should be, so many times it's reasonable compensation. These owners that I've been working with have never gotten the right guidance. And as a result, they are passing through small reasonable compensation because it helps them tax-wise. But if they were ever questioned by the IRS, it could be a problem. We just know that it triggers audits. So that's my get off my soapbox about reasonable compensation. It is something that I see a lot of. So our next section here is one of those sections where it's nothing groundbreaking, right? But what I love people to think about with their taxes is it's two simple components at the end of the day. What did I make and what did I spend? At the end of the day, when we think about our taxes, that's what it is. All my revenue and all of my expenses, right? Obviously, that's a big simplification, but I just like to bring that up there. So that's first section of the 1120S. It's about revenue, right? What are we going to do? We are going to either use our bookkeeping systems, maybe we're using spreadsheets, but this is where, accounting systems are very, very important. And most of the time when I'm working with centers, it's the problem is often the collecting of data, the correct record keeping, things of that nature, right? So I may be in circumstances where, their taxes are going to be excellent if they could get everything together, right? So sometimes it's a matter of record keeping. What we need to do this tax season, next couple of weeks, right? We're going to gather all of our records. If we have some type of software, it's all of our revenue is going to be there, CCMSs, whatever, however we collect that information, fantastic, right? Bank records, your own documents. And I put here 1099 forms, right? Because if you are a participant in the Child and Adult Care Food Program, you receive a 1099 NEC. We're going to talk about what's going on now with payment apps. All right. So starting in 2024, many of you have heard things about this. And let me tell you, it's been a roller coaster over the last 2 years because the IRS all through 2024 up until November had one rule that they were going to enforce for payment apps. And then they changed it in November of last year for 2024. So if you had talked to me last August, this slide would look very, very different. This was changing, but this is the rule now for the 2024 tax season, right? So anytime that you are receiving payments through a payment app in 2024, that for that payment app, the entire amount exceeds $5,000, you are going to receive a 1099-K from that payment app, and the IRS is going to receive a 1099-K from that app, from that payment app. We want to keep in, we always had to declare that revenue. That was always declarable. But now there are going to be 1099s. We're going to have to list them on our taxes. This year, it's $5,000 each app in total, right? So if I have $5,000 through Venmo, I'm going to receive a 1099-K for that $5,000. But if I received 500 from Venmo and 500 from PayPal, you're not going to see 1099-Ks. We're talking about individual payment apps. This year, but next tax season, right? This year in 2025, anything combined from each payment app, $2,500, more than $2,500, we're going to receive a 1099-K. And then in 2026, as it stands now, and remember, we saw changes throughout 2024, it's going to be $600. And for a lot of businesses that claim that collect tuition and fees through payment apps, that $600 is absolutely nothing. You always had to declare it on your taxes. However, perhaps without a 1099, it was easy to overlook and it wasn't being reported directly to the IRS. Now, hitting those thresholds, it will be, right? So we want to be very, very aware of that. There has been a lot of discussion about this because it has changed so many times, and there's a lot of misinformation there. So that's our revenue, right? How much money did I make? We're going to make sure when we do the revenue that we're including grants, that we're including, there's very rarely, I don't want to speak out of turn for LIIF, but I'll just say, generally speaking, there are very, very few grants that are not taxable. So you will want to know the specifics of your grants. Is that taxable revenue, right? Do you have to include that as revenue? Pretty much almost every way that you bring money into your business is taxable revenue. So you can keep that as a general rule, right? Great, we've got all of our revenue. Hey, now it's about expenses, right? How much did I spend? I want everybody to keep in mind that when you're thinking about your expenses, a lot of times I think businesses just kind of like hand stuff over to whoever's preparing their taxes and they're good, right? And that's it. Technically, if the IRS ever wanted to see any receipt for that, that each expense would have to prove that it was paid, the amount that you paid, the date you paid it, and what it was. What was that expense? So again, right, this is, if you have great record keeping systems, this is nothing new for you. But this is the time of the year that we're gathering everything for the 2024 tax season. So this serves as a reminder. And the fact if the IRS was ever to come back, let's make sure we have all of those, all of that proof of an expense. We've got it right there for them, right? So we want to think about that there. As far as business expenses go, this is a very different conversation having this with centers than I do with family child care. Family child care, we have to take into consideration the use of their home. There's a lot of questions about is something an allowable expense. And one of the things with centers, right, is that what defines an expense? Well, it is something that is necessary for running your business. That's an allowable expense. And for centers, the majority of your expenses are allowable expenses. But I would like you to just think of that definition. Is this something that is necessary for running my business? That's an allowable expense. When we get into the gray area, and I'm not saying it doesn't have to be something that absolutely has to be necessary, but it has to be something that makes sense within the running of that business. If it's something that does not make sense with the running of that business, there could be an issue, right? So just think about that whole idea of, do we need this to run the business? So again, centers, very often expenses are very, very straightforward because they're not taking anything personal into account except automobiles. We're going to take a look at that there. So where I run into problems with centers, honestly, is a lot of the record keeping. So I like to keep that in mind. We're also going to look at something about the home office expense, because that actually is pretty tricky. All right, so that's one of the things that we're going to talk about, because these are the challenging expenses that we see when we are doing tax assessment for centers. Classifying employees as 1099 contractors, federally, it's very, very strict. The state of California is even stricter. If I had to say anything to somebody about classifying employees as 1099 contractors, it is not the decision of the business owner, and it is not the decision of the worker whether or not they want to be paid via 1099. There are very strict rules. We're going to take a look at those. Home office expense. In the past, a couple administrations ago, you were able to claim a home office expense, and then that changed. So again, I don't know what's going to happen this year, right? Anything could happen in 2025, but I will show you what the home office expense, how that works in 2024, because that's what we're filing right now. We're going to look at vehicle expenses. We're going to look at food expenses. And I'd like to show you different scenarios of how expenses, how grants and the expenses of that are used, the expenses that are paid for by the grant, what that can look like on your taxes if timing is different. So these are just some things that I'd like to just bring to everybody's attention. So as far as federally concerned as to whether someone is an employee, W-2 employee, or a 1099 contractor, if any one of these exist, that person is a W-2 employee and not a contractor. We have an app at Civitas, basically contractor versus employee, not meaning a fight, right? But hey, which way should I go? We have a QR code. My coworker Tim is going to put the link for that in the chat. It's a very, very simple decision tree, yes or no, that can help you determine, is somebody supposed to be a W-2 employee, or can I pay them via 1099 as a contractor? That app, keep in mind, is about federal. It is not about California. The next slide we look at is about California. All right, so what if we hit one of these? That's an employee, all right? Behavioral. Does the company control or have the right to control what this worker does and how they do it? Boy, right there, right? That puts a lot of folks into the W-2 category. financial. Are all of the business aspects of the worker's job controlled by the business, right? So how the person is paid, are expenses reimbursed? Who provides tools? Who provides supplies? That can define if someone is supposed to be a W-2 employee there. Relationships basically are talking about, like, are there any benefits, right? So is there insurance, vacation pay, things like that? Is this an ongoing relationship? When we say long-term, we know that staff retention is a tough thing, right? Perhaps this is the one that has, these next two are the ones that have a little bit of maybe a little bit of vagueness, but remember, all you need is one, for as far as the federal government is concerned, for someone to need to be declared as a W-2 employee. This is the other thing that one of the other things that when I am doing an assessment of a center's 1120S, I see this problem all of the time, 1099 versus W-2 wages. So when it comes to exclusivity, what we want to just think about is not does this person only work for you? They can have multiple jobs, but basically, where are they fitting in the structure of your business day to day? If they are, if they could own a company, right? Somebody could own a company and you pay that company either a check or you could pay them you could pay them as contractors, 1099, where they're setting their own hours. They come and see you once or twice a month. Maybe it's a music teacher. They have tons of other clients. A bookkeeper would fall under this, right? A bookkeeper is not going to necessarily be a W-2 employee as far as federal taxes are concerned. So this is something that the IRS looks at a lot. And just to show you how serious that California takes it, basically they use what's called the ABC criteria test. The state, the taxation, right? The state taxation, this is what they look at. It's more stringent than stricter than federal laws. So we just went through all of those where so many people are supposed to be W-2 employees. Now we're going to look at this. 3 different criteria, right? So basically, the hiring entity does not control or direct the work performed. Again, right? That the majority of business owners are directing the work that somebody within their business is performing. As far as the state of California is concerned, that's all it takes. If you control or direct them, they're an employee. They're not a 1099 contractor there. If the work is being, what's the best definition? I mean, we have here the work is outside the usual course of a hiring entity's business, right? So that would mean that, hey, if the work being performed is not something that is ongoing in the business, is a position that is required, that we need to run the business, or it's good that we have it to run the business, okay? If any of those, if those things are the case, if basically this person is working for us in the usual course of business, that is a W-2 employee. If they are engaged in an independent business or trade. So basically, really being that this is not, it doesn't even have to say, we don't want to say that it doesn't have to be their main form. They basically are working in an entirely different industry. And perhaps they're providing some type of service for the childcare business. The state of California would say, okay. So just keep in mind, right? If you want to consider this person to be a 1099 contractor, you have to meet all 3. If they just meet one, W-2 employee, right? So if, look at the state of California, it's strict. It is very, very strict. And there are some serious legal and financial consequences. Technically, business owners can go to jail over the misclassification of workers. So huge fines. Also, something that happens federally, and I apologize that I don't know if this is the case in California, but federally, if you were found to have somebody working for you that you have been paying as a 1099 that should have been classified as a W-2 employee, you have to pay all of the back business taxes, right? Payroll taxes, excuse me, that you would have paid for them. You have to pay half of what would have been their withholding taxes. So this is not something to mess around with. And I do see it over and over again when I do a tax assessment and I laser focus in on that contractor line on the 1120S, because if that's a larger number, I'm going to have a discussion about, and just run these rules by everybody. So this is something that's very interesting that is also a red flag for the IRS. The 2017 tax code, what basically happened is they almost eliminated claiming the home office expense. And a lot of people don't realize this. This first bullet point alone is very interesting. You cannot claim a home office expense if you have office space available elsewhere. What that means is that there is no possible place at your place of business where these duties could be performed. So if you have an office in your center, right? We have a business office. That means you can't have a home office. So if there is space for these activities that you need to conduct, if there is space in your regular place of business, you are not supposed to be claiming, even though you might be doing some work at home, you are not supposed to be claiming the home office expense, right? In terms of the space for the home office expense, it has to be exclusively for business. The IRS technically could argue with you if your family is using the printer. Not kidding. So nobody does anything in that room except the other computers are linked to that printer. Whoops, that if they wanted to, they could fight that there. Basically, if you are not a sole proprietor, there's what's the regular method, which is measuring the square feet, dividing that by the total square feet of the home. Some of those numbers turn out to be absolutely tiny when you look at expenses there. If you are an S corporation, you would currently have what's called an accountable plan, right? And an accountable plan exists as a rule, a set of rules about how people get paid back expenses, perhaps how expenses that maybe an employee lays out some money for an expense, or they go on a business trip, or an accountable plan talks about that. And basically, whatever that accountable plan is, if you are able to claim your home office, you have to repay yourself following the rules of the accountable plan. So keep that in mind there. If you're going to go forward with it, if you meet all of those, please keep floor plans with measurements, logs of the type of activities you do there, photographs. Seems crazy, right? It's very different than it used to be, where we were all claiming our home office expense. Could it change? Absolutely, right? Tax code this is set, I believe, to expire as of 2025, but you also can just extend it. So something you want to be aware of. Now, as far as vehicle expenses, I do see this come up. We know that a lot of centers have their own business vehicles. They have, vans or buses or something along those lines. But a lot of times a business owner of center is also using their personal vehicle. There's no doubt about it whatsoever, right? What we want to make sure is that we are documenting the heck out of it, that we are only using it, we are only going to claim the expense for when the vehicle is used in the course of business. We're going to keep our personal travel in that vehicle and our business travel in that vehicle separate. Child related, you can expense grocery store trips. It doesn't have to be dropping a child off at school or something along those lines. It really is related to the childcare business. I should have both of those as one bullet there. So basically, transportation costs, it has to be regular in the course of business, right? So here are some typical expenses related to the children. So basically taking children to and from school and the field trips, taking them to medical facilities, or as I mentioned before, the trips to go buy supplies, to buy groceries, right? Those are the things that, or if you were driving to a continuing education, perhaps a symposium or something of that nature, yes, that is a business use of a vehicle. So just whenever you're thinking about, if it's not something that you're using your car to drop off or pick up a child or go to basically go on a field trip or something like that, and we're talking more about these trips for business purposes outside of the care of children, please understand that a trip can be personal and business, but it's only deductible if the primary purpose of the trip was business. So I love this. I have this example of pickles. Civitas have been using it for years, but let's say you go to Costco, you have a long list of supplies, but there's a jar of pickles there. Your family loves pickles. You put pickles on the same receipt. That's still a business trip, right? That's still a business trip. But if you went to the supermarket and you were doing shopping for your family, and then you're like, oh, I forgot diapers or wipes or sanitizer, whatever that may be, that is actually not a business trip. That is not something where you're going to be expensing that vehicle expense. So what it comes down to, right, is that there's some pretty strict record keeping. The most record keeping is if you use the actual expense method, which is exactly what it sounds like. And it usually results in higher expenses. All right, so actual expense method, basically, what are we going to do? Well, we're going to keep track of all of the use of the vehicle, every single trip, personal and business, right? We're going to keep proof of every payment, because when you talk about the actual expense method, we are also talking about gas and repairs and all sorts of things that way. What's great about it, chances are it'll be a higher deduction. There's a lot of bookkeeping. I'm going to pick it up a bit. I apologize, I'm going kind of slow on there. Standard mileage method is exactly like it sounds. Keep track of your business miles. It's easy to, basically really easy to document. The IRS does not scrutinize it as much. You are limited in 2024 and as of right now, 2025, to 67 cents a mile. That's super, super easy. This next expense I put here, most centers have this down pat, right? Food expenses for the children. You always want to keep in mind that there are just two odd things about food expenses. If you're feeding your staff, the food you feed them technically is only 50% deductible, only 50% of that cost. And if your own children are in the program, you're not supposed to expense their food. So just kind of keeping that in mind. All right, so actual expense method is the only expense method for food that's available for centers. So we want to keep that in mind there. If you are currently participating in the CACFP, just follow the same method of record keeping. You're already doing that. The CACFP is very strict record keeping, right? That's exactly what we're going to do for all of the documentation, of course, then equating food costs to that. If you're not following the CACFP, if you don't accept that, there's a lot that you're going to do. You're going to be recording the child's name, meal counts by type, breakfast, lunch, dinner, snack. Basically, they can ask for the menus, the actual menus served, attendance records. There's a lot that goes into this, but as centers, you don't have another option. Family child care businesses can also, they have the actual, and then they can also use the CACFP Tier 1 meal rate to calculate meals, which can be a lot easier than this. Grant funding and expense timing. Again, people ask me questions about this. This is less of something that comes up when I do an assessment of taxes and more of when somebody has an unhappy surprise, we'll say, and they're questioning me as to why this happens, right? So the rule of thumb, right, is that Grant funding is going to be considered revenue and is going to be taxed, but almost always the expenses, what you're using the grant money for, are almost always allowable expenses. So we go, poof, that just kind of washes itself out. Except I'd like to look at 3 different scenarios. So scenario number 1 makes perfect sense. The revenue that we received from the grant and the expenses were both in 2025. Fantastic. Probably they're going to offset themselves to a certain extent, right? In this instance, I received $10,000 in grants. Why does that not say $10,000 there? It should say $10,000 in expenses, taxable income. Hold on, am I on the wrong thing there? Oops. Let's just listen to what I say and not to that slide. Tim, you want to make a note for me that I made a mistake on slide number 43? So basically 3 different scenarios. One scenario is we receive the grant money in 1 year and we have the expenses in the same year. They're going to offset themselves. Fantastic. We have another situation where what if the grant money is more than the expenses? There could be a circumstance in which you do not have to spend all of the grant money. I know it's not common, but it could happen. When that happens, right, on our taxes, we have the grant money, let's say $20,000, but I only have $10,000 in expenses. Well, what happens there? I'm going to pay taxes on that other $10,000. I need to think about that. That grant is not completely offset by expenses. And basically what you can have in this last scenario is that what if we receive a grant in 2025, but the grant allowed us to use it for past business expenses. So in this case, I'm allowed to say, okay, I'm paying myself back for expenses I had in 2024. Well, in 2024, you took those expenses off of your taxes, even though you didn't have the grant money that year, right? So 2024, you had elevated expenses. But in 2025, you get all of that grant revenue and you don't have the expenses to offset it anymore. And you're going to be paying taxes on the entire grant revenue. I want you to just keep in mind those different scenarios, right? When you're thinking about taxes, when did I receive the money? When did I have the expense? And were the expenses the same amount as the grant money? Is it basically a wash? Or can I expect that I'm going to be paying taxes on some of this grant money there? I have down demystifying depreciation. I will go on record as saying depreciation is something that often is best left to tax professionals. But what I want everybody to know is to understand what depreciation is, right? Because I'd love for you to have a good conversation with a tax preparer, and I'd love for you to think as you purchase things, as you gain assets that you've purchased, do those need to be depreciated? I want you to think about that. What is depreciation? It's basically you buy an asset, you pay for something, and if it falls under the rules of needing to be depreciated, it means that the cost of that, the expense of that, is spread out over time. If it falls under the depreciation rules, you don't get to take that expense all at once. It's going to be over several years. So perhaps we expected we were going to take that whole expense and offset our taxes that year. And then it turns out, no, we have to expense it over a series of years. And that's what creates different timing, right? So the fact is that revenue and expenses may not line up. You make a very large purchase and you think you're going to take it as an expense that year, and instead it's spread out over several years. That is what depreciation is. Okay, often it does intimidate childcare business owners. I have there, business owners in general, right? But if you don't prepare your own taxes, I still would love for you to know about depreciation. And I'm going to share with you some accelerated methods that after I talk about all of this, you'll find that there potentially could be methods that you do not have to depreciate something there. So there are very, very simple steps that are taken to determine if something needs to be depreciated. And we're going to look at those acceleration methods there. Just giving this example, when we talk about spreading an asset over time, let's say we have an expense in 2024 that was $30,000, but based on the schedule that the IRS sets schedules for every type of asset and tells us how many years we have that we have to basically expense that over that amount of years. So in this instance, I had a $30,000 expense. Oh, but with depreciation, I'm only allowed to claim 10,000 of it every year. So that very first year, wow, there's $20,000 in taxes, $20,000 in revenue that I'm going to be taxed on because it didn't lower my taxes. It wasn't a $30,000 expense. And the years to follow, great. I didn't have that expense in 2025, and I get to take $10,000 as an expense because it's depreciated. Same thing happened in 2026. You will find that you may, when working with tax professionals, there may be a very good reason that they want you to depreciate something. So I will talk to you about accelerated methods, but it doesn't mean it's always the right choice for you. Okay, how do we determine if something needs to be depreciated? Super easy. We're going to actually look at a flow chart. I'll just run through these boxes. Is it ordinary and necessary for the business? If it isn't, it's not a business expense anyway, right? Can the item last more than 1 year? If yes, is the value, the cost of that item, more than $2,500? If the answer is yes, we move to the next. Is this a repair or maintenance cost? If it is not a repair or maintenance cost, it could be subject to depreciation.
Hey, Jennifer,
yes.
just want to let you know we have about 20 minutes left.
Thank you. And boy, am I only halfway through these slides? I'm going to pop it up. Thank you very much. So sorry. Told you it was a long one. This is a flow chart. This is going to be available to you when you receive the slide deck. It's asking the same questions that I just asked, right? Is it necessary? Does it last more than a year? Was it more than $2,500? Was it a repair? We could follow that. So when you get the copy of the slide deck, go ahead and follow through. Acceleration opportunities, basically, what do those mean? Well, they mean that technically there are exceptions to depreciation. There's so many details to these that I'm not going to go into everything about them. However, keep in mind there is something called Section 179 depreciation, bonus depreciation, safe harbor depreciation. Those are all methods in which you may be able to take all or some of an expense all in 1 year, right? So basically not spreading it out over the course of many years. I would love for you to speak to your tax professional about this. If you've made something, go through that flow chart. You purchase, I should have said purchase. You had a purchase in 2024, would fall under that. Just ask if, would it make sense for Section 179, bonus depreciation, safe harbor. That's for federal. In California, California does not recognize that bonus depreciation. All right. So when you're speaking to somebody about your California state taxes, just understand that you will not be able to depreciate on your state taxes using bonus depreciation. So just kind of keeping that in mind there. We have a couple things that are specific to California. Basically, when it comes to estimated taxes, right, everybody knows that you need to pay estimated taxes throughout the year. There's basically, if you are not paying at least 90% of what your taxes were the following year, technically, or previous year, you could be fined. Okay, so there could be penalties there. When it comes to state income tax in California, often state income tax needs to be considered extra. All right. So what you want to do basically is always think about, as an estimate, that 4% of your overall revenue should be estimated taxes for the state of California. So you just want to keep in mind that you need to account for that, right? There are rules for franchises. There are rules you'll see here in the state of California for S corps, C corps, including LLCs that are treated as S corps. So you are going to want to speak to a tax professional about the rules for if you are an S corporation or choosing to file as an S corporation. If you are a franchise, basically there is the rule that LLCs and corporations have to pay a minimum franchise tax of $800 regardless of the income. And then there are franchise taxes for higher profits. So do not be surprised when you see that you are paying a franchise tax because that basically exists in California. Want to really quick go over what's happening with the so sad situation with wildfires. There is tax relief if you are in Los Angeles County. Basically, what they have done is they have moved the deadline from April 15th, in most instances, to October 15th, 2025. If you fall under this and you're a victim to this, income tax, estimated taxes, payroll taxes, any type of returns that need to be filed for partnerships, C corporation, S corporation, all of that has been postponed to October 15th instead of April 15th. Please speak to a tax preparer. I'm going to get very excited about the next thing. When do we ever get the chance? We're in 2025. When do we ever get the chance to mitigate our taxes from 2024? Well, again, you're going to get the slide deck. I would love for you to speak to somebody. Retirement plans, you actually have until April 15th to open a retirement plan through the business and lower last year's taxes. Only time you get to do that. Just keep that in mind. So as a small business owner, you can open a retirement plan through your business from January 1st. You could be doing it last year and that would be just fine too. But if you found all of a sudden you have extra higher taxes, please consider opening a retirement account through the business because you can lower last year's taxes. In 2025, I'm so sorry that we're running so far over. I would love for everybody to think about this concept. An expense and a credit are not the same thing. Tax credits are extremely, extremely valuable. And the reason for that is because they are dollar for dollar reduction on your taxes versus a percentage. So if I look at this example, this is an individual who has a tax rate of 31.8%. She has an expense of $1,000. Well, that expense of $1,000, she is saving reducing her taxable revenue, right? She's saving $318 in taxes. A tax credit, $1,000 tax credit, is $1,000 saved in taxes. So when you meet with your tax preparers, please ask them if there are any available tax credits for you. Circling back to retirement, there is what's called the Secure 2.0 Act that actually for 3 years allows you to have your expenses for setting up a retirement plan covered. There are additional credits you can receive for having your retirement plan set up so that there's just automatic enrollment when an employee comes on board. All sorts of credits for setting up retirement plans. Really some fantastic savings. Other credits you have to do with how much you can get a credit if you are paying some of your employees' healthcare premiums, a certain percentage there. I think a lot of us know about family medical and leave in terms of the allowable time. However, there are credits if you are paying some of that medical leave there. We have a situation where if you have the work opportunity tax credit, there's a whole list of people who have fallen under certain circumstances that you can get a credit for employing them. And then the employer provided childcare facilities and service credit is fantastic in the fact that it is a credit for businesses. Let's say your local pizza parlor, right? Your local pizza parlor basically has a contract with you and they're going to cover some of the expenses for childcare. They can receive a tax credit. I encourage our childcare providers to become somewhat a salespeople. Go out into the community, find businesses that need the children of their employees cared for, set up a contract, reserve some of your slots for the children of the employees of that business, lock in some enrollment, let that owner of that business can potentially get a credit. The same thing works for if you were to approach a business who had space to have a child care facility on their property, in their facility there, and you decide to start a new business within that facility. Again, tax credits for that business owner, great way to get them involved. Throughout 2025, I want you to think about a couple different times here. May to June, right? We've already paid 2024 taxes. Let's continue to organize our revenue. July through September, I want you to look at last year's information. And I want to see, look at where you were at previous year. I want you to kind of do a comparison. I want to see, where are you with expenses? Where are you with your, with your revenue? What does that look like? Are we paying enough estimated taxes? So I want you to think about that. October through December, I want you to look for opportunities to mitigate your taxes if that's what you want to do. If you want to lower your taxes, let's think about expenses that we could have to lower that. And here where we are right now, January through April, getting ready for tax season. We're getting all our documents together. I see retirement contributions. We're considering or opening a retirement plan. We're working with a qualified preparer. I want you to think about your taxes throughout the year. We don't have to go crazy here. Mid-year review, I want to make sure that you are on track for paying your estimated taxes. All right. There are different ways that you can go about doing that. Really what you want to see is, basically looking at the previous year taxes divided by 4 if the revenue and the expenses for the year, the tax year, the year that you're in, if they're similar, just take last year's taxes, divide it by 4, make sure you're making those payments. If those circumstances are not similar, we need to make an adjustment, right? Because we don't want to be overpaying or underpaying our estimated taxes. Please, when you get the deck, if you don't mind, this will be slide 66. Please go here to see how we would recommend, it takes a while to kind of walk through this, how we would recommend that you do some estimated tax calculations if the years aren't similar, right? If our profit and our expenses are different than the previous year and we can't just divide our previous year taxes by 4. Take a look at this, all right, just so that you understand, because what I love is when we get to quarter 4, we haven't yet paid, we're paying our quarter 4 estimated taxes in January. When we get there and we realize, oh my God, we've already paid enough in estimated taxes. We now can take that money. We don't have to make that payment, or we don't want to pay a fine. Oh, looks like that fourth quarter payment better be higher. Please take a look at this. All right. Basically, if we're in, when you're in 2025 and we want to lower, when we're thinking about 2025 taxes, I should say, you want to lower your taxes, contribute to a retirement plan, look for other expenses. Paying down debt, I'm not saying that that's lowering your taxes, but boy, it puts you in a great place financially, as does creating a reserve fund. You may invest in a business expansion. Fantastic. Tax benefits there. I don't recommend the deferring income. I'm not even going to talk about it. It's a game. If your tax preparer chooses to do that with you, fine. Or, do you want to make, basically charitable contributions? If your revenue is low or negative, you may need professional guidance, right? We're going to control expenses. We're going to look at our billing and collection processes. What do we need financing options? I hope we don't. I hope we can create, a strategy there. Is our pricing right? So if you're starting to look at things and the revenue is not looking so good, make a change. That you're very smart business people, but just make a change while you still can. As far as
10 minutes, Jennifer.
Thank you. Okay, where am I? We're going to be good. I promise we're going to be good. In terms of finding qualified tax preparers, a lot of centers do have qualified, but if you don't, ask within your community. Bookkeepers may know. Reach out to your attorneys. Look for people, tax preparers who participate in the annual filing season program. And then perhaps LIIF can help you, right? So use all of the resources at your disposal. And when you do sit down with a tax preparer, you're looking at a tax preparer, we want to know their credentials. Have they worked with childcare centers before? Are they familiar with the documentation needed and the calculations, right? And these next 2 things, are they available for any type of questions you have after tax season? And most importantly, can you get a copy of your return and copies of everything you gave them? You get those documents back, right? I want every 1099. I want everything back. So that's what 2025 can look like for you. And I'm so glad that LIIF is going to post the deck. They're going to post this recording. I know there were things that we had to run through, but now I'd like to see if there are any questions in the Q&A, in the chat. Do we happen to have anything?
We do have one question in the Q&A box. It says, if you don't spend all the grant money this year and some expenses pour into the next year, do you need to pay taxes for the difference?
Yeah, so remember, if we receive $20,000, but we don't have $20,000 in expenses in the same year, we're going to be paying taxes on the difference. The next year, when we have those expenses, our tax liability is going to be lower because we didn't have the revenue, right? The revenue came in the year before. Now we get to take extra expenses. So it balances out in the long run, but it affects you in the tax year in which you receive the grant but don't have the expenses. Have anything else? Anybody would like to come up? Yeah.
You have one question in the chat. Can you elaborate more about a reserve fund?
Yeah, so when we're talking about a reserve fund, we're talking about really reserve can equal emergency. So what we want to think about is when we look at our cash flow and we see those months that are, we've got feast, right? Not famine, we've got feast. We look through the rest of our cash flow, say we're looking at 6 months, and hey, the other months are doing really, really well. I'm not going to need to borrow, to take extra cash, so to speak, that I had in 1 month and apply it to the next month. Things are looking good. The forecast is good. I'm going to take that extra. I'm going to start to put it in an emergency fund, in a reserve fund. I'm going to look for the best way to, the best place to put that money that I could potentially get it back fast. And those could be high interest savings accounts there. So there, unfortunately, interest rates are coming down. At one point, it was 5.25. Now I think it's between 4 and 3.75. But find a place to put that money where it can grow when you don't need it, but you can get it back fast. That is usually the recommendation for when we talk about reserve funds. We look at that cash flow and we see when can we put money, could be towards a future expansion, and again, could just be emergency fund, right? We want nothing more than to have money available when something happens that we're not planning for.
Thank you, Jennifer. I do have 3 more questions. I'm going to give them to you in the order they came in.
Sure.
How many years should we have to keep our records?
Yeah, so it depends on the type of records. Honestly, this is going to sound excessive where I'm going to say 7. It's usually 3 to 5. So if anything, at the minimum, let's say 5 years, please keep your records. There are some that you only need to keep for 3 years. That's a lot of the food expenses and things like that. But 5 years is a very, very safe number for keeping all of your records.
Thank you. The next question is, if the grant is $145,000 and they spent $144, so left over $1,000, is it possible to put it all as expenses instead of appreciation? No, I'm sorry. Put it all as expenses instead of depreciation.
Well, remember, you have to have an allowable expense to take it completely. And in terms of depreciation, some of those rules, like Section 179, will allow you to take certain expenses all in 1 year and not have to depreciate it. So that's if you're thinking about something where we have something that we think, oh no, was going to have to be depreciated, and therefore it's not offsetting the grant money that I received. Speak to a tax professional. Bring up Section 179 would be the first thing. If you brought up the bonus depreciation, keep in mind the state of California does not acknowledge bonus depreciation.
Can those differences be deferred?
Can those differences? So if I had $145,000 in a grant and I had $144,000 in expenses, technically, right, if we're talking about a specific grant, I can't help you in terms of deferred expenses. And the reality is that wherever that imbalance is, you would be paying taxes that tax year that you received the financing, that you received the grant.
Thank you. The next question is, can you give an example of allowable retirement plans?
Mm-hmm. So I would love for you to talk to Fidelity, Vanguard, Charles Schwab, or perhaps even your local credit union about what's called a SEP IRA, SEP IRA. I would love for you to talk to them about a simple IRA. These are all run through the business. There's nothing wrong with 401ks. You certainly can speak about those. They are complex. They do cost a decent amount of money. Now, we know that there's a credit that could help us with that for 3 years. There's a lot of maintenance that goes into a 401k. When you talk to somebody about the SEP IRA, a SEP IRA is perfect for a business owner whose employees basically are saying to you, there's no way we can contribute, we never want to contribute, but you want to contribute on their behalf. So a SEP IRA, basically, you would be contributing a percentage of the employee's wages to their retirement fund. They do not make contributions. So if we're thinking about a SEP, it's circumstances where we want to contribute to an employee's future. However, they're not going to be putting anything in it. I love a simple IRA. There's 2 different ways with a simple IRA, and I prefer the second one. The first simple IRA is basically employees can contribute, but even if they don't, you have to contribute 2% to their retirement funds. The second, you have to choose 1 or 2 methods, and the second method of a simple IRA is basically does involve a match where you have to agree that you're going to match an employee's funds anywhere from 1 to 3%. But remember, you're only matching if they are contributing, right? Which is different than that first option with the 2% regardless of whatever they're doing. So I like a simple IRA with that option number 2, which is a match. Yes, you are going to be matching some of their funds. If they choose not to participate, you are not paying a dime. If they decide that they're going to do 4% of their salary, but you've declared as a company that you are matching 1 or 2%, that's what it is. They can certainly continue to contribute. So simple IRAs, inexpensive. The tax credit will allow for the covering of a lot of very inexpensive, and the tax credit, I don't want to say we'll cover all of it, but let's say we'll cover all of it there. Very simple to set up. Vanguard, Fidelity can certainly help you. The beautiful thing to keep in mind is that you're paying yourself, you're paying your retirement through your business and getting a tax deduction, right? That's why we say, hey, we have up until April 15th to do this. In what world, not only can we go back into 2024, reduce 2024 taxes, but have something that we are taking towards our future personally and reducing our business taxes. Retirement plans are an amazing vehicle for tax reduction and to save your future. Tim, I'm sure you put civstrat.com in the chat. That's Civitas Strategies website, civstrat.com. There's resources there. We have a whole section on retirement, and we have an app that will walk you through your different options. So please go to the Civitas Strategies website to take a look at that. I've also put here on the screen, this is how we're handling those questions, right? If after the fact, let's say you look at the deck, you look at the video, and you're like, oh, I wish I had asked this, or what does she mean by that? Go to tomcopelandblog.com. You can research if you'd like, or there's Ask the Experts. Click on that. Tell me that you're with LIIF. That you've attended LIIF, the presentation. Give me your question, and then in a week or so, 2 weeks from now, I'm going to record a video. We're going to post it on our YouTube channel, which is simply Civitas Strategies. Over 600 videos there. We, anything that Civitas has recorded with our Zoom, almost everything we put there, tons of topics. But that's where one of the places that I'm going to post the video of me answering questions is here. And the other place is going to be on the blog, on tomcopelandblog.com. So if you think of anything after the fact, if you think we went through something too fast, maybe it's estimated taxes because we didn't go through a lot on estimated taxes, please use the Ask the Experts option on at tomcopelandblog.com, and I will be gathering things and answering questions.
Thank you so much, Jennifer. We are at time. If you still have questions, please, we welcome you to follow the link provided in the chat to go directly and ask those questions. We will also share out these links via email, along with the presentation deck and video recording. And I'm going to pass it on to Cindy to close us out.
And thanks for having us, everybody. Just want to say it was a pleasure to see everybody.
Thank you so much.
And thank you, Jennifer and Tim, for hosting this webinar for us. We're hoping that your inquiries and questions and thoughts were answered through this presentation. And everyone have a great rest of your day.
Thanks, everybody. Take care.
Bye-bye.
Bye-bye. Leslie, just so you know,